Peter the Hitman Heckingbottom, turn the Dutch Dynamo Dresmer, and Dave Boy Fishwick.
So what's your view on bond markets, Peter?
Yeah, I think bonds are a really different asset class to equities. Basically a bond is a loan from an investor to either a company, when it's called a corporate bond, or a government, when it's called a gilt or a treasury. So a really different market, because bonds are traded on a market, which is called the bond market, but they don't really have the potential to go up or down quite as much as equity markets. So really a bond on maturity is always going to be worth £1. So really what we've got to look at is what affects the price of bonds on the bond market, because that's really what drives the return that investors could get. And really there are two key things that drive the price of bonds. One is the creditworthiness of the company that's borrowing the money, or the government that's borrowing the money. And two is the outlook for interest rates and absolute interest rates at the time that investors are making their investment. And there's a really strong correlation, a statistical correlation between the outlook for interest rates and the future value of bonds after you've bought them. And that correlation works so that if interest rates rise, the value of bonds fall, and conversely, if interest rates fall, the value of bonds rise. And that's why bonds have been a fabulous investment really for the last 10 years, because interest rates have been falling, bond prices have been rising, and everybody thinks that bonds are just the panacea for all investment solutions. They give a nice stable return, they give far better rates than cash deposits, but at the same time you don't get the volatility of the stock market. And I think that's absolutely right, but what you've got to be really worried about as an investor is what happens when interest rates rise. And I say when because it's fairly obvious that that's the only direction that interest rates are going to go. They've got to go up. The issue is when. But we don't quite see it happening this year, and maybe not early next year.
And do you have a view on the commercial property sector?
Yeah, I think the UK commercial property market is an absolutely valid investment class that people should invest a proportion of their money in. And our asset allocations models, particularly for lower risk clients, have reasonable proportions of investments in UK commercial property. And really what you've got with UK commercial property is probably a more predictable return than you've got either in equity or bond markets. And what you can see if you look at a graph over time is yields staying pretty flat in commercial property. So in other words, the rental income that commercial property owners receive from owning those properties and from them being tenanted out, from the tenants, the rental income that's paid has stayed fairly flat for the last 2 or 3 years at just less than 1.75% a quarter. Whereas the capital values of commercial properties have fluctuated quite wildly. They started off in 2010 by going up. Later in 2011, you were actually receiving capital losses from owning commercial property. And just in the summer of 2013, we started to see prices rise again. So the total returns that investors have got are the yield and the capital appreciation or depreciation. And we're just beginning to see now, as measured by the IPD index, both those factors moving positively. And we think that's moderately positive for commercial property in the future. So we think it's a decent asset class to invest in, but nowhere near as spectacular as equities.